And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Good afternoon, and welcome to my podcast. What a day today. I mean, it's amazing. When the tech market gets sick, it really just screws everything up, doesn't it? It really does. So I'm going to explain to you what's going on in the market. Everybody says, what's going on in the market? And you listen to these dopes, okay, on CNBC and the rest. They don't know what they're talking about. Sort of like, they'll come out in the morning and say, wow, let's look at the numbers. Did you see Amazon's up 2-3%? Did you see this was up 4%? Make it sound like, wow, they really moved. I better get that stock. When they're not a good stock. In other words, they didn't really move that much. They moved on the day. But when you look over the stock in a full trend, it's a terrible stock. But they'll make a stock that moved one day look like it's a champion. Wow, look at that stock. Wow, that really moved 1.5%. And you look at it on a chart, and you look at the trend is terrible. The trend's been going down. So in other words, it's like if you take a trend and draw a line going down, and all of a sudden the stock's getting worse and worse and worse. But then when they report it in the morning or at night, when they close the market, they go, oh, boy, this stock did really good. Stock X, look at that, up 1.2%. Boy, that was a performer today. No. The overall stock's in a big downtrend. Just because it went up on the day doesn't change the fact that the stock sucks. Okay, it's been going down. So don't get caught up in that stuff, okay? When they're talking the performance of the day, unless you are a day trader, close your ears to that because it'll really screw you up because it'll get you into buying stocks you shouldn't be in. Also, have you ever wondered why the market hasn't crashed? I mean, everybody go back and look at, the dot-com crash, the housing crash, 2020 crash. Why isn't the market crashing? Or how do they just keep the market up? And that's another thing screwing up the market. People just get in the market, especially people who haven't been near the 1970 crashes or the 80 crashes or 2001 crash. They're too young. They just think the market just goes up. All you have to do is put money in the stock market and it just keeps going up. Buy a tech stock, keeps going up. Well, the real reason the market hasn't crashed, okay, if you want to call it that way, because things are screwed up. Think of it as three pillars, if you will, okay, three pillars. So, and you got this wobbly house being held up by three pillars. That's our stock market, wobbly stock market being held up by three pillars. The foundation, okay, it's not that good, right? So, in other words, the house should have fallen a couple years ago, and it didn't fall. And it's a wobbly house, and the foundation, being the real economy, is cracked. So people are, think about the economy. People are drowning in credit cards, right? We know that. Everybody's drowning in credit cards. And people are, groceries, insurance, everything we need for crushing families, unless you're making $300,000 a year, things are hard on people. If you're making your household's making $65,000 to $85,000, two of you are working, even $100,000, two of you are. It's hard. It's hard. So people are drowning in credit card debt. So let's think about this again. So think of a house that's very wobbly. Okay, and it's being held up, this wobbly house, by three different pillars. And so, this, as I said, this house should have tumbled years ago. The foundation is the real economy is cracked. People are drowning in credit card debt, rent, insurance, groceries, all crushing, right? Companies are laying off, but they're doing it quietly so the news doesn't pick up on it. Growth is terribly slow, okay? So let's take pillar one. So the Fed keeps pumping air into this room. the ballroom, right? Even when the Fed says it's fighting inflation, they've kept liquidity high. So they're saying they're fighting inflation, but they're pumping liquidity. The liquidity is high liquidity. So think of that pillar one. I'm trying to explain pillar one holding up the house, the market. So the Fed's telling us one thing. They say they're fighting inflation, but they keep on pumping liquidity in. Rates. Okay, again, they've kept rates from going too high. Markets, the confidence. Okay, there's just no confidence, to step in the market. There's not a lot of confidence. Things are breaking. It's like going in an old house, you hear a crack, you want to step in, things are breaking. So pillar one, we got the Fed is not fighting inflation. They shouldn't be putting liquidity in, but they are. That's a problem. They keep rates too high. They're not cutting. And so that's pillar one. They're doing everything they shouldn't be doing. Think of that. Now we look at pillar two, the foundation. Look at the pillar. Look at it's a little wobbly. Well, what's going on with pillar two? Why isn't there a crash? Well, pillar two, big tech is carrying the entire market. So there's one big tech. Okay, he's holding this whole house up, right? So a handful of companies, NVIDIA, Amazon, Google, Microsoft, Meta, right, Apple, Tesla, have become the earnings engine, the growth story, the safety net trade, the AI dream. So you got a handful of companies. You have any stocks? There's 8,000 stocks that we know of, right? That they bat around over 8,000. But here you got NVIDIA, Amazon, Google, Microsoft, Meta, Apple. Got 9 stocks, about 9 stocks. That's it, holding up the whole thing. So again, the earnings engine. Here's where the problem comes. Okay, so the earnings engine, the growth story, the safety trade, the AI dream. Okay, so they're so big that when they go up, the whole market goes up. Even if everything else is falling, it's like a big fat guy jumps in the pool, right? 500-pound guy jumps in the pool, you get these big waves, right? And all of a sudden, all the kids around the pool jumping in. Oh, look at the big waves, they're going to jump in. That's what happens in trading. You get 5 of these companies, they all jump in the pool, big wave, and then think of the little guys like kids, the little traders like kids around the pool, see the wave. Oh, we better get in. Look at those waves, man. We can have some fun. They get in, the waves dissipate, right? So they're so big, these companies, a handful of companies are so big that when they go up, the whole market goes up. And it creates an illusion that things are good. But it's the second pillar of the house. And the house should have fallen years ago, but it's not fallen because you've got these pillars that are bad, but they're all being held up by just a couple things inside the house, okay? I mean, it's just, that's what's going on in the stock market. So you have it's like having 7 giant adults holding up a collapsing roof, right? And while the rest of the house is sagging. That's what's going on. So that's what's going on with our market. We have 7 giant adults holding up a collapsing roof while the rest of the house is sagging. So, and then the other one, just think of it as pillar 1, again, as a summary, okay? The house is still standing, but again, this is another pillar that's, it's rotting away. We have too much liquidity. The rate's still too high. They're not willing to cut the rates. The third pillar that's holding up the market also is a bunch of nonsense. You have passive investors, okay, passive investing. And they buy no matter what. The computers are set so they just buy. 401ks is a great example. The other day we saw 401ks, they're kicking in automatically, index funds, right? ETFs, and they're buying like crazy, right? I mean, so think about it. 401ks, the index funds, the ETFs, they buy automatically. Like you and I don't buy automatically. They buy automatically every paycheck, every month, every quarter, right? And so every month, every quarter, they just automatically buy. They don't care where the stock market's at. They just buy. And they don't care about valuations. They don't care about earnings. They don't care about debt. They just don't care. It's all programmed automatically, these 401ks. So that's what's going on. So the market hasn't crashed because three giant forces are holding it up. So it's, the Fed, it's big tech, and the automatic buying, okay, from these 401ks, right? And the economy is weak, but the market is being propped up like a wobbly old house and held up by three pillars, right? So what we're seeing is an old house that wants to collapse, but there's certain things that are just holding up, and everybody's holding their breath. That's the stock market. That's what's going on with the stock market. So, and the other thing, when you're running a market and you're playing the stock market, the reason people lose so much money, especially first thing in the morning, they listen to the people on Fox, CNBC, and the rest of them, and they get them all excited to buy something. You shouldn't buy until 5 after 10, because only by 5 after 10 you'll know how good that stock will be that you want to put money in. If you just are patient and watch the opening of that stock, let's say it was at 100, and the low was 95. Now, and you're thinking, I better get in that stock right now because Kramer said get in, buy, right? So it was at 95, right? It went to 100. But all of a sudden, it drops from 100. Let's say the opening was at 95. And the opening high was 100, the low was 95. People jump in. 20 minutes later, that high that we had is gone. It's got wiped out. So you're losing money already. So always make sure, because there's a few people things that are holding up this wobbly house. So when the market opens at 9:30 and you're looking at Microsoft, we'll say, just use a crazy number. Let's say it opened up at 100 on the high and the low is 50. And all of a sudden, 20 minutes later, 15 minutes later, it's no longer at 100. It's down at 40. Well, all these people jumped in when it was at 100 thinking, oh, things are good. Look, it's at 100. If you look at your chart, we call it our Pro 3 chart, it will never hurt you. Now, you just want to know, where is this stock opening? I just want to know, can it hold the opening high today? This morning, it was up 100. Last night, it closed at 90. It's at 100. Now, how long can that hold? And then can that keep going up all day long? That's a strong stock. But people don't give it a chance. They see their favorite stock open, they jump right in and start buying. It's like the big fat guy who jumps in the end of the shallow part of the pool, all kinds of big waves. The little kids think of that as the market. They all jump in thinking there's a lot of big waves we can play. In fact, there was no big waves. This fat guy jumped in the pool. It's the same thing with the stock market. A fat guy jumps in the pool, the shallow end, making waves. People jump in that don't know what they're doing. Exactly what we go through every day when we watch the market. So today, people are excited because the market went up 700 points. But remember, there's this big fat guy who jumped in today and caused all these waves, and all the children are jumping in. That's why this market went up so much. So that's why you got to be very, very careful. And these markets, see, what's the market? Yeah, I mean, you got to be really, really careful. Really careful, because that's how you lose a lot of money. So the market, how many times have we seen the market? We're up 858 points, right? On what? A couple companies. Now tomorrow morning you wake up and all of a sudden the market could be negative. You go, oh, now I'm losing money. And what hurts too is during earnings season, because these earnings seasons throw things off. Because every stock is going to be its own estimate. Every stock seems like it's doing well, but it's not. So when we get into about week and a half of the earnings season, once we get through the tech stocks, things will settle down. So think of the stock market as a wobbly old house, and you got people holding this thing up, and one day it won't hold. But you know how to short. You'll make money. Thank you for joining me. See you on the charts.